Now that we understand what market structure is, how we can identify a bull or bear trend, and how it applies to supply and demand, the next logical step that we must take is understanding the multi-time frame level of market structure and how we're able to dissect a bear trend or a bull trend on the higher time frame and understand how the components apply fractally down onto the lower time frames. So for example, if the daily chart is showing an uptrend, making higher highs and higher lows, if we're looking at a lower time frame, we would expect to be seeing higher highs and higher lows. But the one thing that we need to start to understand is the fractal nature of the markets, in that we will see higher highs and higher lows on the lower time frame, but we're also going to see a series of lower lows and lower highs as it facilitates the pullbacks on the higher time frame. And here we have a standard textbook infographic of an uptrend and a downtrend. As we can see with the uptrend, price is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. We then break to the downside, creating a lower low. We create a lower high. We create a lower low. We create a lower high and a lower low. And if we take that a step further and say that the blue line is our higher time frame structure, so say a daily time frame, and the red structure is our lower time frame structure, so let's say 4 hour or maybe even 15, what we would see as price is moving to the upside, we'd see a series of higher highs and higher lows. We'd create that highest high on the daily time frame, our higher time frame. And then when the higher time frame is starting to pull back or retrace to put in its higher low, what we would be seeing more than likely on a lower time frame is a break of structure, creating a lower low, a lower high, and then a lower low. This lower low that forms on the lower time frames is in essence the higher low that's formed on the higher time frame. And then what we'll see is as price begins to move to the upside as this higher low has been formed, we'll see on the lower time frame that price breaks structure, putting in a higher high, we'll put in a higher low, a higher high, a higher low, and then a higher high, which forms our higher high in this case. And as we can see, once we get to this point, we've broken the previous higher time frame's higher high, and we're starting to see the continuation of the bull trend. And this will continue, and as we'll see, when price begins to retrace on the higher time frame, on the lower time frame, we'll start to see a series of lower lows and lower highs until we put in the higher low on the higher time frame. And then at that point, we'll see a break in structure, and we'll start to see the lower time frame creating higher highs and higher lows, higher highs and higher lows. We'll see price then break that higher time frame structure and start to put in a higher high. And again, on that lower time frame, we're still seeing a series of higher highs and higher lows. We'll put in that highest high, and then we'll see price switch trend against. And what we'll often see as well is price may not actually break structure on the lower time frame as well. In this example, what we can see is price basically creates a double bottom, but price is within this range of price on say the 4 hour or 15-minute time frame, and we haven't actually broken structure. We haven't actually created any lower lows. We're still in a bull trend. This can also happen as well, so don't always expect that lower time frame has to create lower lows and lower highs as it's retracing in a bull trend. But then we'll see price starts to build higher highs and higher lows once more. We break the higher time frame higher high, putting in a new higher high on the higher time frame, and then the cycle continues where we start to see a lower low printing a lower high. And at this point, what we can see is our higher time frame swing structure would be here. And as we break to the downside, what we can now see is we're seeing a change of character, meaning that we were expecting a higher low to form and price would continue moving to the upside, but what has actually happened is price has broken the previous higher low and is now forming a lower low. And as we can see on the lower time frame structure as well, we're creating lower highs and lower lows. And as the higher time frame puts in a lower low, we can see that price is logically going to start to retrace or correct. And on the lower time frame, we can start to see that price is creating a series of higher highs and higher lows. Well, we can see in this case, we would break this structure. This would be the higher high on the lower time frame, which would form our lower high on the higher time frame. And then what we can see is price then starts to move back to the downside. We create a lower low, create a lower high, a lower low, a lower high, a lower low, breaks this previous low, confirming our bear trend, creating that lower low. And then on the lower time frame, we're still creating lower highs, lower low, which is also our lower low on the higher time frame. And then what we see is price is now starting to make a series of higher highs and higher lows, higher highs, higher lows, higher highs. That creates now our lower high on our bear trend. Price then breaks to the downside, creating a lower low on the lower time frame, and then starts again the cycle of making lower lows and lower highs as it continues down on the bear trend. And this is what is happening conceptually on all time frames, because what essentially time frames are on a price chart are just a series of data that you can graphically depict using different time frames. The time frames itself are just data, different ways of viewing that data, which is why you can pick different time frames, and why if you're using TradingView, for instance, that you can start to look at custom time frames like 45 minutes, 30 minutes. You can use 8-hour time frames, 3 hours, 2 hours. At the end of the day, the time frames in which you use are ultimately up to you in terms of what data you're hoping to gain from the chart. But one thing that I do strongly suggest when it does come to market structure, mapping market structure, and following a logical flow in market structure, it's best to pick a few time frames and follow them more specifically, because what will end up happening is if for a while you're using, say, the daily, the 4 hour, the 1 hour, the 15 minute, the 5 minute, then the 4, 3, 2, 1 minute, you're going to start just looking through time frames to essentially match whatever it is you're trying to find on the chart. Whereas if you have your main time frame, so me personally, I like to use the daily, the 4 hour, the 15 minute, and the 1 minute. Those are the time frames that I focus on, and those are the time frames that I watch. So anything else that's on there, I don't really concern myself with too much. I will also look at the weekly and the monthly for higher time frame understandings of what is going on, but the main time frames that I'm concerning myself with on a daily basis are the daily, the 4 hour, the 15 minute, and the 1 minute. And if I'm always locked in on those time frames and I'm constantly monitoring what's happening on the daily in terms of the higher time frame market structure, then looking at the 4 hour for the market structure, and then the 15 minute, we can build a solid understanding of what is happening on all time frames. If I know that the daily's in an uptrend, we've just put in a higher high and price is starting to pull back. I know realistically on the 4 hour and the 15 minute, what we would likely see is a downtrend, especially given if the range in price on, say, the higher time frame is large. That means the pullback in theory could be large. And if I combine that with supply and demand zones, map out where, in this case in an uptrend, where all the demand zones are that would, in theory, cause price to continue higher, I can then map out where logically higher lows would form. And if I'm using lower time frames and I know that price is making a series of lower lows and lower highs approaching my demand zone that I'm looking to enter on, then I can make higher probability and more informed trading decisions by using and understanding market structure. We're going to tie in market structure with how we go about looking for entries. We're going to piece all of this stuff together, but the main thing is understanding supply and demand, how it integrates with market structure, and then now understanding how all of the different timeframes can build that overall picture of market structure and how all of the trends that we're seeing are being built on all time frames. It's all happening fractally, meaning that it'll happen on one time frame, it'll happen on another time frame. Generally speaking, trends will start on the lower time frame, say the 1 minute, and build their way up. But at the end of the day, the direction that's easier to find, follow, and navigate is the higher time frame trend, because effectively what is needing to happen is if you see a trend change on the daily chart, for instance, it's going to take a few days to actually build what you would understand to be a trend change. Whereas if you're looking at a 1 minute trend, you can see price creating higher highs and higher lows for a few minutes, and then creating a series of lower lows and lower highs for a few minutes, and then creating more higher highs and higher lows, creating that uptrend. But then if we were to zoom out, maybe go to a 15 minute, then what we can see is that movement on the 1 minute was actually just an uptrend on a 15 minute, and fractally that's what was happening. We were seeing that uptrend, we were seeing that correction that was on the 15 minute chart, but it looked like a downtrend on the 1 minute chart, and then we started to see that uptrend again because the 15 minute began to make a new higher high, and vice versa with a bear trend. So this is something that's incredibly important to understand. It's something that fundamentally many traders understand, but they don't put as much emphasis in truly mastering and understanding how one time frame translates to another. So really take the time to understand this approach, understand market structure, understand its importance, and how we can create high probability trade ideas by understanding the narrative that's being built on the higher time frame and how it works its way down to even as low as the 1 minute, 30 second, 5 second time frames. They're all building these sorts of trends, and if we can put all of the data together in a logical manner, we can make incredibly informed trading decisions based on the order flow. We start to throw in supply and demand concepts, and that opens up a world of possibilities on what the markets are ultimately going to be doing. Let's take a look at an example of multi-time frame market structure in action. We're going to build on the example that we used in the first video on Euro US dollar here. So what we can see is we were in an uptrend. We were making a series of higher highs and higher lows, higher highs, higher highs, higher highs, higher lows, higher lows. And we started to switch to a downtrend, making lower lows and lower highs. I'm going to focus on a little bit more recent price action. That way we can actually look at lower time frame data. But as we can see currently, here on the daily chart, we are continuing a bear trend. As we can see that we've put in a lower low right here after breaking this daily higher low. And just before we close the week, we have more or less wicked the daily level. So we haven't actually broken the daily level, making a lower low just yet, but we have started to see some action. But on a lower time frame, what we will see is a break of structure. So now that we have that understanding, we're basically going to concern ourselves with more or less this bit of price action, probably more specifically here, but we'll see how far we can get as we navigate downwards. So let's jump down to the 4-hour chart. And what we can see on the 4-hour chart is, again, if I just go to the daily chart, we can see that I have my structural points mapped with these gray highlights. And when we go down to the 4-hour structure will be indicated with the blue highlights. And we'll just kind of stick right here as we started to switch bullish, which is the more recent price action. And as we can see, we were on a downtrend on the daily chart, and we didn't actually get signified that price was switching bullish here on the daily chart until we broke this high right here. But as we can see, if we're mapping out and following the 4-hour charts, is that our real change of character when the 4-hour switch from bearish to bullish happened when we broke this swing high, or this lower high on the bearish leg. Because as we can see, we had a lower high right here. And if we just kind of map back just a little bit, we can see that price was in a downtrend. We are making lower lows and lower highs. And I've now just realized I'm using the wrong colors. Just fix that very quickly. But as we can see, we're making lower lows and lower highs here on the 4-hour chart. As we continue down, the daily chart created a lower low here, a lower high here. We broke, which confirmed this lower high. We then continue moving down, creating a lower low on the daily chart. So on the daily chart, price was stuck within this range of price. And if we were looking for a continuation to put in a lower low once more, we'd be waiting for price to form some sort of lower high and then continue to the downside. And as we know with multi-time frame market structure, on the 4-hour, if the daily is to remain bearish within this overall range of price, if we were to move to the upside, we would start breaking structure to the upside, creating higher highs and higher lows on, say, the 4-hour chart before continuing to the downside. And what we can see on the 4-hour chart, again, is that we broke structure on this point here. We started to create an uptrend. We started to see higher highs and higher lows being formed, especially in this spot where structure got a little bit more tight knit, and this is range created demand, as we would know. And what we can see is what ultimately created this break of structure, this daily break of structure, putting in a higher high, would have been this break of structure here. But as we can see on the 4-hour chart, we were already starting to switch bullish around here. We started breaking structural points, creating higher highs and higher lows within the overall trend. And as we can see, price continues on making higher highs and higher lows. We've broken this daily swing high. So when we're looking at the daily time frame, if I just pop open a second chart, and we'll compare the daily to the 4-hour just so we can look at it a little bit more granularly. So again, we're looking at price creating lower lows and lower highs. When we look at the 4-hour chart, we can see that price breaks this high and is starting to move to the upside. We can see the momentum here on the daily chart. We can start to see these large candles popping up. And if we're looking at it from a supply and demand lens, we would be looking at this as a potential supply zone that would be holding price. On a 4-hour, we can see it is a very large pivot supply where we get this large sharp up move followed by a large expansive down move that creates supply in the market. And what we can see pretty clearly as well, if we just pop that back on the daily, we have a singular pivot supply candle, this bullish candle before this rapid expansion to the downside. And what we can see is price does react off of this supply zone. So in a perfect world, if we were looking at market structure and we're looking at lower lows and lower highs being created, we're looking at this range in price, we start to see price retracing. Realistically, if we're looking to catch the lower high and look for an additional short opportunity, we'd be looking to identify supply zones that would coincide with the formation of that higher low. So in this case, we have a supply zone here that we would be expecting price to react off of and create a lower high and continue moving to the downside. But what we can see is price does initially tap into the supply zone. We get a bit of a reaction. We start to see a pull away in price, but at the end of the day, we don't get a true follow through. And what ends up happening is we then switch from supply to demand and continue moving to the upside. And what this will be known as is a supply and demand zone flip. We'll dig into those in future videos, but what we can see is this is the first sort of aspect of supply failing. And we're starting to see demand being respected. As I mentioned in the previous video, we're creating higher highs and higher lows. And we're also seeing supply being invalidated or failing. And we're seeing demand being respected, which is creating that bullish market structure. And if we just continue on, we can see that we had a supply zone here as well. This is more of a fractal supply zone. This would be the pivot supply, this last extreme. And what we can see is price reacts off it once again. And as I said in pretty much every video up until this point, that when it comes to supply and demand zones, we are likely going to see a reaction, but it's the follow through that's most important. And what we can see is price does react, and we can even see it on the daily chart. We had 1 day of selling, and then followed by demand being respected and price continuing to the upside to create a higher high on the 4-hour chart and begin to create a higher high on the daily chart as well. And if we just continue on moving, we can see that as price begins to move up, we start to see a series of higher highs and higher lows forming on the 4-hour chart. And we finally print in a daily higher high right here. And then we start to see price moving to the downside. In this case, price doesn't actually break true valid structure. The reason this point is not viewed as structure is because of these equal lows, which is an area of liquidity. We'll touch on liquidity a little bit later on, but something to keep in mind as we progress through. But as we can see, even if we were to have considered this valid structure, price would have broken to the downside, created a lower low, a lower high. We then would have broken structure and continued bullish. And because we know that the daily chart is now in a bull trend and we're expecting a higher low to form and price to continue moving to the upside, we would not be looking to immediately take sell positions just because the 4-hour is switching bearish. Because again, this is the importance of understanding multi-time frame market structure. We're trying to understand what's happening on the higher time frame. We're trying to trade in line with that higher time frame, but using the lower time frame to gauge where entries may be possible and to understand the market structure. Because if we are just blindly looking at the market, not factoring in the daily chart, looking for sells at, say, this supply zone would seem incredibly valid, seeing as this is range created supply. We have a large drop to the downside. We're breaking structure or liquidity in this case and continuing on. We would expect that to hold and sell off. But as we can see, supply is totally ripped through. It's totally disregarded and price continues on. Why? Because on the daily chart, we're creating higher highs and higher lows. We are in an uptrend. And furthermore, what we can see is supply is failing. Supply is failing. Demand is being respected. Demand is being respected. And what we can say, if we take this even one step further, we have range created demand just right here. And what we can see is this next point is held up by demand. And we can see price is creating higher highs and higher lows as price carries on in its trend going higher and higher. And then as we can see, as we just navigate our charts, this is where we start to see that change of character. This is where we're starting to see the beginning of the downtrend that we're seeing here on Euro US dollar. And what we can see is on the 4-hour chart, we create a high, we break that high, creating a higher high, which is also the higher high on the daily. But this is where things start to change a little bit. Again, if we're looking and factoring in the daily chart, we would see that price is in a larger range. We can see that we have our daily swing low here and our daily swing high here. So we're trading within essentially this impulsive leg, this range of market structure. So as a result, we would still be ideally bullish as it stands. But then if we just navigate our way out, what we can see is we are approaching a daily supply zone. So we have a couple different options to look at from a trading perspective in terms of, do we think this supply zone is going to hold, therefore causing price to move to the downside, or do we think it's going to be disregarded and continue the uptrend? And this is where we can start to look at lower time frame fractal market structure to gauge the reaction, and we can trade those reactions. So what we can see on the 4-hour chart, once we tap into the supply zone, we see a large move to the downside quite rapidly. And what we can see initially is that price disregards a demand zone almost immediately. We get a small reaction. As we can see, price does move to the upside, but ultimately that demand zone fails. But what we can see is we do have a demand zone. Now let's just zoom in so we can see it a little bit better. We can use the entire pivot if we'd like, or we can refine it to the most recent candle. What we can see is demand does get respected. So right now we're seeing a series of supply getting respected, demand failing. So we can just draw on that demand zone as well, just for reference. You can see demand failing, demand being respected. This is more an extreme level of demand versus a minor level of demand, because this is more in the lower portion of the range of the daily price action. And what we can see if we just continue on is we have our supply zone here created as a result of price moving. And what we can see is we respect that supply. And realistically, if we were looking at demand, we can see that we have range created demand right here. Price disregards that demand. So we're starting to see that change in the flow of supply and demand. And what we've seen here, once we broke these lows, is that price broke market structure with this large drop here. So we've put in a lower low. We've come back in, we've tapped into supply, and what has ended up happening? We've failed demand, and we've continued down to create a lower low. So what this is now telling us is that the supply zone on the daily chart is starting to change. We haven't actually changed market structure on the daily yet. So up until this point, we are still bullish on the daily, but what we're starting to see is on the 4-hour, we're starting to get indications that the trend may be switching, that this is a true change of character. We're going to start to see that change of character on a lower time frame before we see it on a higher time frame, and that's going to give us a better understanding and identification of what is to come, and we can build trade ideas on that. And what we can see if we just continue moving on is we have a supply zone right here within this inside bar, or even specifically in this wick. Doesn't quite get hit. We have an inside bar. So basically within this area, we can see that there was a lot of trading happening here. Just do something like that. It does wick the supply zone a little bit, but not a big deal. What we can see is we have supply. Ultimately, it's respected, and then price continues down, breaking structure to the downside, creating another lower low, and then price essentially falls off the cliff here. And what we can see is what we had one last level of demand. And if we just draw it on the entire range that was created, we tapped into it once, we've tapped into it twice. We've basically absorbed all of the demand that's sitting at this level. And what that allows price to do is free fall to the downside. And what we can see is price then has created a lower low here on the daily chart. And on the 4-hour chart, then we're starting to see bullish structure, and that bullish structure is in line with a pullback on the daily chart. And then what we can see is now that the daily is starting to potentially break to the downside, we're starting to see a lower lows and lower highs being printed on the 4-hour chart as well. And then now what we can do is take it one step further as well and look at the 15-minute chart and just dig into the price action. It'll be the exact same story, but it'll just be even more fractal in nature. So what we can do is we'll keep our eyes on the more recent and relevant market structure, just so we don't get lost in too many details. So we'll look at the recent market structure that has happened since the drop here on the 15-minute. What we can see, if we just start looking at this point in time, zoom in just a little bit more, so we can actually get a good view here. You can see that we've broken structure to the upside after being in a downtrend. So if I just map on a few more points just to showcase the trend that was in play up until this point. See that we've broken structure to the downside. broken structure to the downside. So we're creating lower lows and lower highs. Again, if we're looking at this point, it's within this candle. We're in a downtrend on the daily now. It's been confirmed after breaking this structural point. If I switch to the 4-hour and maybe draw these on a little bit better because TradingView is giving me a hard time today. Here we go. That there, perfect. So what we can see is price again is making lower lows and lower highs. And if we're looking at this on the 4-hour chart, we can see that this bit of structure here is this bit right here. And as we can see right now on the 4-hour chart, we are also in a bearish move. And what we can see here on the 15-minute, the 4-hour change of character and the 15-minute change of character end up being at essentially the same points. What we can see is it's created by these two candles. We see that impulsive move to the upside. We've now switched to bullish, but again, if we switch back to the daily chart, we know that we're still in a bearish trend. And what happens when we are in a bearish trend and we've just put in what seems to be a lower low, we're going to get some sort of pullback, especially after we break structure. A question we always should ask ourselves: what happens after we break structure? We will continue running for a while, but ultimately what's going to happen after that? We need to pull back. Why? Profit taking needs to happen. The market needs to breathe. It's been over injected with selling pressure in this case. So at some point we need to start to see a relief rally for price to correct, price to pull back, price to retrace, whatever way you would like to describe it. But at the end of the day, the higher highs and higher lows of a market, or the lower lows and the lower highs of the market, is basically the ebbs and the flows of the market. And it's also the market breathing. We're exhaling, we're inhaling, we're exhaling, we're inhaling, we're exhaling, we're exhaling, we're inhaling, we're exhaling, we're inhaling, we're exhaling. If that's the way you want to view it, great. Whatever makes the concept make more sense conceptually, that's the best way to approach it. But as we can see here with the 15-minute and the 4-hour, we start to get an alignment of market structure where we get this large expansion to the upside, and it creates the 4-hour swing high as well as the 15-minute swing high. And we'll just switch this chart back to the 4-hour again, just so we can see a little bit more structure. Once again, the highlighter's being funny with me. Just like that. And what we can see in this case, we then break structure to the upside. And what we're doing now is we're just waiting for more confirmation as to what's actually going to happen. Got that. That's our structural point. And what we can see when we're looking at the 4-hour as well as the 15-minute, we have a structural point that is mapped. We're basically caught within the range of price, this leg of price right here, which is from this low to this high. Not sure why that's not appearing. And as we can see, price is caught in a very large range in price. And what I have here with these green circles is substructure, just mapping out and understanding what's happening while we're stuck within that range, because often what we can do is we can start to get a good indication of what may or may not be happening, and we can start to make trading decisions based on that on an intraday perspective. And as you can see, we have a few different zones mapped out. We have a supply zone, we have a supply zone. We're in an overall higher time frame bearish trend. We're bullish on the 15 and the 4-hour, and we're starting to see a large aggressive pullback. We can definitely say that this is quite impulsive to the downside. So what we want to be seeing is demand failing and supply being respected. So what we can see within this wick, which is a refinement that you'll see in video 4 in the supply and demand series, there is a demand zone resting within this wick. And what we can see is when price tests into that wick, we get a strong reaction. We have a supply zone that's resting within this inside bar, again, video number 4. And what we can see is price respects that as well. So we're caught between supply and demand, and now it's a matter of what is going to hold, what is going to start failing, and what can we start to gain from that? Well, we know that the 15 and the 4-hour are predominantly bearish currently, but we also know that the daily is bearish. And what we know is right now the daily is in a phase of correction. We're waiting for price to find a lower high to continue to push down if it is in fact going to make a lower low. So when we're looking at this bit of price action, we're just waiting for demand to fail and supply to be respected if we are to go bearish. But if we start to see demand being respected and supply starting to fail, then that can start to give us a solid indication of what is to happen next. So what we can see is overall this demand zone is holding price. We can see that this supply zone ends up failing, And then we can look at the next supply zone, which is this inside bar. We get a slight reaction just prior, and at this point, price then continues moving to the upside. One other area that we could look at is within this wick. This would be that continuation pattern, again, spoken about in the 4th supply and demand zone video, where we have this continuation supply zone. We get a strong reaction and price then begins to move to the downside. And what we can see is we failed demand, and price continues dropping. But again, where do we drop into? We drop into a demand zone. Now, one thing I want to stress though, when it comes to multiple taps of a demand zone, is the more taps you get into a supply or demand zone, the weaker those zones are inherently going to get. So at that point, although this is propping up price as it currently stands, it's something that we should be mindful of as price begins to develop that it can only hold for so long. And once it's tested too many times, then likely we'll see a break of that level at some point. But as we can see, demand is being held. And at this point, what we're looking at is still a continuation of the overall bull trend. And what we can see is price then continues moving to the upside to continue pushing higher. And then we can see, again, we're still caught within this overall range. We've just broken 15-minute structure, but we didn't actually break 4-hour structure. So this should actually be different color. Plop that on. There we go. So we've broken 15-minute structure, but if we look on the 4-hour, we didn't actually break that 4-hour structure. And what actually we can do is move this right there, because this would be our highest point within the trend. But we've never actually broken that bit of structure. And then what we can see is we get a violent sell-off. Price continues on. We create a supply zone. Price taps into it. We're respecting supply, and we're starting to break demand once again. We can draw a demand zone in this particular area. We can see it does hold initially. We get a reaction. We tap into supply. We respect supply. We respect demand. We're now having the dance of supply and demand. We can see that we do have a demand zone right here that is initially respected. We come back in, tap into supply once more, or fractal supply that's resting within these wicks. And what ends up happening, price then moves to the downside and starts to switch to a bearish trend on the 15-minute. What ends up happening as we continue moving further on is that price then breaks the 4-hour low, which is this low right here. And now what this has created is a downtrend on the 4-hour and the 15. So we're starting to really get confirmation that price is moving to the downside and that sells are on play. And what this is going to also help us understand is that more than likely the daily chart is going to start to continue moving to the downside, if in fact that was the lower high that was printed on the daily chart as well. And what we can see if we just continue following market structure is we are breaking structure to the downside, creating lower lows, lower highs, lower low, which is our true 4-hour lower low. We can see price creates a lower high on the 15-minute chart, consolidate, creating a larger supply zone that we can see on the 4-hour chart right here. And then price begins to move to the downside. We create a new lower low on the 15-minute chart. Price then begins to more or less move sideways that we can see on a 4-hour chart, but we can get some structure on the 15-minute chart, and which we can see, again, we're looking at a potential pullback on the 4-hour chart because we have something that looks something like that, which is lower lows and lower highs being printed. And what we can see is the 15-minute chart then switches bullish to accommodate that lower high that is being printed on the 4-hour chart. And then what does price do? It continues to move to the downside. And again, all this is doing is following the daily structure. We're putting in lower lows and lower highs. We put in a lower low, we pulled back, we created what appears to be a lower high. But again, we haven't actually closed below this structural point. So for me right now, this isn't a confirmed lower low, but it's definitely a good indication. We were able to understand why price was beginning to switch and seeing the changes of characters that were happening as we look through the 15-minute and the 4-hour. We can take that a step further and begin looking at 1-minute market structure, but that's a little bit more advanced. And personally, that's what I use for entries as opposed to looking for pure market structure. It's best to have, say, a 4-hour and a 15-minute time frame for your market structure, and then have an execution time frame that you're using for actual entries when you hit the particular points of interest, supply or demand zones that you're trading within the overall direction of the 4-hour, 15-minute, and daily market structures, and not sitting on the 1-minute chart just looking for breaks of structure and trying to trade with that. Of course, you can frame up a lot of great continuation trades at a more advanced level, and we'll get into those intricacies. But for now, it's really just about mapping out your daily, your 4-hour, your 15-minute structures, and really understanding how each of those timeframes play together to build that overall trend. What we can see is quite easily that the 15-minute was building the trend before the 4-hour and then before the daily. But what we could very easily see too is that it was following the higher time frame trend. We had a good indication of what was actually going to happen on the chart conceptually using market structure, but then we were able to take it a step further by integrating supply and demand. Now, I know that I have more than likely missed a few supply and demand zones as we went through this example, especially if we were to include the examples of supply and demand zone flips, which we'll get into. It'll start to make understanding market structure even easier, even when we start to combine liquidity concepts and things like that. But again, we're going to start from the foundation and build onto that. So right now, the main idea and the main emphasis is on building out the structural components, understanding how daily 4-hour, 15-minute structure plays with each other, and how trends are built and how they follow one another and how they deviate from one another, how we can include supply and demand into those concepts to better understand what is happening. When we see demand being respected and supply failing, we know we're likely putting in higher highs and higher lows. If we start to see supply being respected and demand failing, we're probably putting in lower lows and lower highs. If we start to see supply being respected and demand being respected, we know there's a little bit of a fight that's going on the charts. We need to be a little bit more patient and wait for market structure and order flow to really showcase what it wants to do. And we can see that as we wait. Like we've seen here, price was caught in a range. We were starting to see demand being respected, supply initially being respected, but then ultimately starting to fail. It was respected, ultimately started to fail, and then we did continue on, but we were able to see the inner workings of that. And from a fractal nature of price, we are able to execute trades on a lower time frame for more intraday setups within all of these ebbs and flows, or we can frame up trades on, say, a 15-minute chart using this information as well. This all becomes data to build out trade ideas and understanding of what's happening on the various timeframes. But again, it all comes from the understanding of what's happening on, say, a daily time frame, understanding the structure, understanding the higher time frame supply and demand zones that are happening and that are being created, what they represent, how they relate to structure, and all of the inner workings in between. Once you can truly understand that, things become a lot easier to understand. Things become a lot easier to manage in terms of building overall trade ideas. Often what you'll notice, probably in previous ways, especially if you have traded supply and demand before, is that you're very good at picking supply and demand zones, and you probably found this through your back testing, that you're very good at picking supply and demand zones, but often you're picking the wrong ones in that you might get an initial reaction, but price never follows through, and you seemingly seem to be on the wrong side of the trend all of the time or most of the time. When we start to integrate market structure, the relationship between supply and demand and market structure, that's when the light bulbs really start to come on. Then we'll start throwing out liquidity concepts to really start to improve the odds of where price is bound to go, and start to throw in advanced supply and demand techniques using supply and demand zone flips, where we're going to be able to build a very robust and rule-based oriented trading strategy. But again, we need to start at understanding and mapping out market structure. So what I strongly suggest and encourage is hitting up your charts and starting to plot out market structure conceptually, higher highs, higher lows, things like that, getting comfortable with the fractal nature of the markets. Now, I know we haven't necessarily discussed in detail how to map out market structure in a more rule-based system, and we will do that in the next episode. But for now, just hit the charts, get comfortable with understanding the fractal nature of the markets, get comfortable seeing how the daily, the 4-hour, the 15-minute, for example, interact with one another, and get comfortable with seeing how the trends form on the higher time frame and go down to the lower time frame, and how the trends form on the lower time frame and go to the higher time frame. Because once we have those building blocks, once we have that proper foundation, we're able to make better decisions, and we're able to better understand the market and how it is moving, where it's likely to go, and we can start to build stronger, higher probability trading ideas. And this is where the link of market structure and supply and demand really starts to come into play, by being able to vet out certain supply and demand zones, understand how they work with market structure, and start to understand when a supply and demand zone is likely to be respected or when a supply and demand zone is likely to fail. So now take this to your charts and see what you can come up with. Understanding market structure and the overall trend of the market is incredibly important. You want to make sure that you're on the right side of the market when you're trading. The old saying goes, the trend is your friend until it ends. One of the most important things is being able to understand when the trend is starting to end, so that you can make proper trading decisions, so that you're not caught on the wrong side of the market when it does decide to change. That's where the concept of understanding breaks of structure versus change of characters, and what change of characters imply, is an incredibly important concept, and we'll be building on to this as we begin to increase our level of depth and understanding of the overall strategy and how it integrates to supply and demand. So when we're looking at a standard uptrend, we're seeing price putting in higher highs and higher lows, breaking the previous higher high and creating a new higher high. That's a break of structure, and the break of structure is showcasing that we are continuing to move in an uptrend. We're seeing that series of higher highs and higher lows. We're breaking structure, breaking previous highs, forming new higher highs. And when we're in an overall bullish trend, our expectation is that price will continue to print higher highs and higher lows, and that will showcase an uptrend continuing. Now, how do we invalidate an uptrend? We see the previous higher low being taken and price moving to the downside. That's what we would consider a change of character. So when we're looking at an example of a standard uptrend in a bullish market and how it relates to a change of character, our initial expectation is that price will be creating higher highs and higher lows, higher highs, higher lows, higher highs and higher lows. And as long as we're completing that process in succession, we are in an uptrend. Now, as price pulls down to make a higher low, we're expecting that the next move will be to break the previous high, creating a higher high. So once we form that higher high, we're expecting that as price begins to retrace, that at some point price is going to find a level of demand to then form a higher low and then continue to move to the upside. But what happens when the trend switches, we then, instead of forming a higher low, we break the previous higher low, forming a lower low, and that is known as a change of character. The character initially was bullish. We were making higher highs and higher lows. We've now broken the previous higher low, invalidating a bull trend, and we've now formed a lower low. And one thing to note, because we formed this lower low does not mean that we have immediately started a downtrend. The way we then confirm that a downtrend is taking place is once we formed a lower high and broken this previous lower low, forming a new lower low, that's when we can definitively say, okay, the trend has begun to shift bearish. And again, what we would understand when we see a bearish trending market is that price would be creating lower lows and lower highs with the expectation of that continuing. The way a bearish trend would be invalidated is if the previous lower high is broken and a higher high is formed. That would be our change of character from bearish to bullish. So if we're looking at in a similar example, we have price putting in lower lows, lower highs, lower lows, lower highs, lower low. We're expecting price to form a lower high at some sort of supply area and then continue down to make a lower low. But instead, price breaks the previous lower high and forms a higher high. This is a change of character from bearish to bullish. Again, though, we haven't actually confirmed that price is in fact moving bullish. The only way we can truly confirm that the trend has switched to bullish is we need to see price print a higher low and move to the upside, breaking the previous higher high to form a second higher high. Once we see that, we then enter the same framework of higher highs and higher lows. And we're going to see this happening time and time again on charts where we'll go bullish to bearish to bullish to bearish. Ultimately, when we go back to understanding multi-time frame structure, this is exactly what's happening on a lower time frame when we relate it to a higher time frame. So for example, if a 4-hour is putting in a series of lower lows and lower highs, so what we would see on a 15-minute in this point of area, when we form the lower low and we're starting to create the lower high, generally speaking, the 15-minute is going to have to switch from bearish to bullish. That change would be called a change of character. And then once we create another higher high, we have now confirmed a bull trend on the 15-minute. And then again, if we look at this spot where we form the lower high and then start to form our lower low, we would see the 15-minute or a lower time frame creating higher highs and higher lows. Then price would then break to the downside, breaking the previous higher low, forming a lower low, and then continue to move to the downside. This would be the change of character from bullish to bearish, and this would be the change of character from bearish to bullish. It's as simple as that, but it's an incredibly powerful concept that we really need to understand when we're looking at market structure, when we're looking at trading supply and demand, because once we go a little bit further into supply and demand and start combining everything that we've learned into a trading model, what we'll begin to see, and I'll be getting a little bit ahead of myself when I say this, but just to conceptualize it and keep your mind thinking, is when we have, say, a higher time frame supply zone such as this, price comes into that higher time frame supply zone, we drop down to our lower time frames. This is the type of price action that we are going to be looking for to begin looking for entries on that lower time frame, because at the end of the day, we want to see price starting to change into our overall trend that we're looking to catch. So seeing as this is supply, we'd be looking to sell. If we want the best chance of success for our trades, or the best edge or probability in catching that successful trade, we want to wait for the lower time frame trend to also align with our overall trade idea. So in this case, we're looking to sell. We'd be wanting to wait for bearish price action on a lower time frame, understanding the fractal nature and multi-time frame application of market structure so that we can put ourselves in the best position to win. One thing to also note, and we'll go into this a little bit further once we jump into liquidity, but if we have, say, price creating lower lows and lower highs, we get that change of character, but then price then begins to move to the downside. This is what we would know as a liquidity grab. It essentially took all of the orders that rested above this previous high, but then continued the trend. If we're looking at it from a market structure mapping perspective, instead of this being a lower low and this being a lower low, what actually is happening is this is one price leg. This would be the lower high. This would be the lower low. This would be the lower low. This would be the lower high. This low would then be disregarded. But we wouldn't know that until it happens. And this is why it's so important to wait for that secondary point of structure to be made when you see that change of character to really validate a trend. Now, of course, if you want to be aggressive and start looking at a change of character on that initial break of structure, you absolutely can. But if you wait for that secondary break of structure to confirm the trend, you're putting yourself in a better position to win. You're waiting for more confirmation. Therefore, you're increasing the overall probability of that trade working out or that trend starting to actually form in your favor. Of course, there are positives and negatives to being conservative or aggressive when it comes to applying this sort of information. If you're conservative, you might miss trades. If you're aggressive, you might take more losses. But as we dig into more concepts, we'll be able to add certain things that will help improve your overall edge. But at the end of the day, the most important thing is understanding how these change of characters integrate to the multi-time frame aspect of the chart, because what you're going to see when you look at any price chart, any trend, we're going to see this type of market structure playing out when we're switching from bullish to bearish, bearish to bullish. Initially, we had a bullish character or bullish market structure. Once we break the previous higher low, we have then switched the character from bullish character or bullish structure to bearish character or bearish structure. In this case, we are seeing bearish market structure or bearish character, and then we broke the previous lower high, forming a higher high. We've now switched from bearish character or bearish structure to bullish structure or bullish character, which is why it's called the change of character. And one thing to finally just mention is break of structure versus change of character. At the end of the day, they are one and the same. The only difference and the underlying difference that makes a change of character different from a break of structure is the change of character changes the trend. The break of structure is just simply a break of structure and can apply both ways. But generally speaking, if we're looking at break of structure, we have said that price is respecting the trend and it's doing what we expect. So if we see a break of structure to the upside in a bull trend, we're expecting higher highs and higher lows, and we're seeing higher highs forming via that break of structure. Now, if we're seeing higher highs and higher lows, but then that higher low is broken via break of structure, that's a change of character. Again, a change of character is a break of structure that changes trend. A break of structure is simply a break of structure, but more often than not, we gear it towards trending markets, because at the end of the day, it only really takes one opposite break of structure to change a trend. So therefore, a change of character is one point of a break of market structure. So what I recommend doing now is just really familiarizing yourself with this concept, how it relates. It's not an overly complex concept to understand conceptually, but it is something so powerful and something that we're going to be using a heck of a lot as we continue to, as we begin to deepen your understanding of supply and demand, as we begin to deepen all of the concepts being put together. Because what we can start to see when we're looking at changes of character, we have a demand zone. We're expecting demand to be respected for price to put in a higher high, for example, but instead demand fails, and what we end up seeing is supply being respected. And like I said in the market structure videos, if we see supply being respected and demand failing, we're in a downtrend and we're expecting lower lows and lower highs. If we're in an uptrend and we're seeing demand being respected and supply failing, then we're in a uptrend and we're expecting higher highs and higher lows. Now on the flip side, if we're seeing demand being respected and supply failing, and then all of a sudden demand fails and supply becomes respected, we've seen a change of character. And we can apply that whether we're using market structure or we're using supply and demand, because at the end of the day, what we're able to do is we can derive market structure from supply and demand because they are one and the same. Market structure just gives us a little bit slightly different lens or framework that we can understand and use to trade. But it's as simple as that in terms of changes of characters and how they apply to the overall market. So definitely make sure that you understand this concept and are able to apply it on the charts. That we have a firm grasp on market structure and identifying and understanding trending markets and how they create higher highs and higher lows for bullish trends and lower lows and lower highs for bearish trends, we can now move on to the three different types of structure and what they represent when we're building our overall picture of structure. In the previous videos, we were mentioning market structure in the example of higher highs and higher lows for a bull trend. We were referring to swing structure, and what swing structure is the larger structural ranges that are created when price is trending, whether that's making higher highs and higher lows or lower lows and lower highs. We use swing structure as the basis of understanding our overall trend when we're looking at analyzing any financial market. And when we're looking at that swing structure, that's where we get the large impulses or expansions to the upside or downside, followed by some sort of correction or complex pullback before we end up breaking the previous swing high or previous swing low in a bear trend. And ultimately what swing structure is going to allow us to do, especially from a higher time frame perspective, is it's going to give us an overall bias and an overall structure to work with in understanding where price is likely to go. Now we can move on to what substructure is, and I had mentioned briefly what substructure was in the previous videos, but more specifically what substructure is it's the corrective structure within the overall swing range. So as we can see, our swing range is between this low and this high, and any price action that happens within the low and the high of the swing structure would be considered substructure. And more specifically, the corrective price action that we're seeing, the counter trend. So in this case, because we're in, say, a bull trend, we had already made a previous high, we broke that high, we've pulled back, and now we've created a new high. We're expecting some sort of higher low to form before we run the previous higher high to create a new higher high. And as a result, we need to put in some sort of downward price action. So in order to make that higher low, we need price to correctively move counter trend, so in this case downwards, and the formation of that, the structure that is created, is called substructure. And as we can see, our swing structure is bullish, but our substructure is bearish. So the swing structure, we're creating higher highs and higher lows, and the substructure contained within the swing structure of this low and this high is creating lower lows, lower highs, lower lows, lower highs, lower lows. And we're able to understand substructure and plan out where we would expect a reasonable pullback. And we use substructure to create the understanding that we know that when price creates, say, a higher high, more than likely what price is then going to do is going to retrace or correct in a counter trend fashion to put in a higher low. Once the higher low has been established, price will then continue moving to the upside and eventually break the previous high point. So what we can do with the substructure is begin to develop ideas of where price is likely to react off of putting in that higher low and then continuing to the upside. Now, there will be a few different areas or a few different situations that we can use substructure to understand where price is likely to react. So in a bull trend, if there was a demand zone within the swing structure leg that we're caught in currently, more than likely that would be a reaction point for a higher low to form. Another option or area that price could see a higher low form and the continuation of the trend is if liquidity is created and then swept by a higher low and then continuing to the upside. We can have the combination of liquidity being swept and a demand zone being tapped into to continue the trend. And what we can have is the combination of all that, the sweep of liquidity, the reaction of the demand zone, and then a supply and demand zone flip that we could look to enter on. Now, of course, we haven't actually discussed supply and demand zone flips or liquidity concepts as of yet, so don't stress too much about that. We will be getting into that in future videos, but those are the main things we would be looking for as substructures being created. We're trying to gauge the impulsive leg of the swing structure to figure out where price is likely to react off of, to put in that higher low and then continue to the upside if the trend is to remain bullish and put in a new higher high. So once we've established substructure, we can see that price is trading within this range of this swing low and this swing high. Price begins to correctively move to the downside, which is known as our substructure. Once we see a change of character, so we were creating lower lows and lower highs. Once that paradigm shifts and we start to put in higher highs and higher lows, we're able to conclude that a change of character has begun. We switched from bearish substructure to bullish minor structure, and the minor structure is in essence the pro-trend structure that's contained within the swing structure. So again, all of this price action that's happening between the swing high and the swing low is what we would call a complex pullback, and we're able to delineate the two different groupings of structure within the impulsive range of the swing structure as substructure for the counter trend pullback and minor structure as the pro trend move that hasn't quite broken the high as of yet, but we're starting to see that shift in order flow. We're starting to see that shift in the overall structure. We're able to use minor structure to gauge that change of character and start to understand that we were putting in lower lows and lower highs within the swing range, and we're now starting to put in higher highs and higher lows. So again, like I said with substructure, we can use that to gauge where a higher low is going to form by looking for demand zones, sweeps of liquidity, the combination of demand zones and sweeps of liquidity, as well as supply and demand zone flip zones. And then we can take that a step further with the minor structures. Now that we've seen a reaction point, we're starting to see a change of character. We can start to look at price moving to the upside. And this is where we can start to look at continuation type trades. So when we're looking at swing structure, we're under the understanding that we're creating higher highs and higher lows. We know that when we create a higher high, we're expecting a pullback. And if the trend is to remain bullish, we would expect a new higher high that takes out the previous higher high. So then when we're looking at price action in that corrective phase, which is counter trend that's forming our new higher low that we're anticipating, we can use substructure to understand what's happening there to then look at the impulsive leg to determine where a demand zone has been created, or if a demand zone doesn't exist or price reacts off of, say, a sweep of liquidity, then we can start to look for potential entries. Now, of course, if we didn't want to look for entries at that point because we didn't have enough confirmation, but we don't necessarily have to look for entries at that particular point, at that higher low. We don't have to be the first ones into a trade. We can wait for additional confirmation. So once we get that actual change of character, we were going from lower lows to lower highs, and now we're starting to switch. We created a new higher high after breaking this lower high. We have that change of character. We're starting to develop minor structure. And once we get that minor structure, we can start to look for entries to look at attacking at least the previous swing high and continuing to make a new higher high if the trend is to remain bullish. And the same would be said for a bearish trend where we have an impulsive swing structure. We have our swing low, we have our swing high. Price would be making a series of higher highs and higher lows substructure. And then once we break a piece of substructure where we violated this higher low, we have now created a lower low. We're now starting to see minor structure playing out. And then once we break the lower low of the swing structure, we can see that price is continuing on in that overall bearish trend. Now, one other thing to note is looking at substructure and minor structure is not going to be an end-all be-all. It's just to create a framework and an understanding of what is happening between the swing structure, what is happening when we're putting in a higher low or a lower high, depending on a bull trend or a bear trend. What we may see is an impulsive move to the upside. We might see price correcting, creating substructure. We see that change of character. We might even get a new higher high, and we're starting to look for entries, and then price could continue down, creating more substructure, and then continuing to the upside and actually breaking the high. Because as we said in the previous market structure videos, as long as this low is not violated, we're still in a bull trend. Price can range all throughout this entire impulsive leg of the swing structure and still continue and break the high to be valid. So although we had our change of character right here, we're starting to see minor structure playing out. What we can see is then we had another change of character, creating lower lows and lower highs. So we're creating lower lows and lower highs, then we started creating higher highs and higher lows. So we had substructure here, we have minor structure here, and then we switch back creating lower lows and lower highs. So we switch back to substructure, and then we start creating higher highs and higher lows. We get our change of character right here, and then we eventually do break the swing high. And this is something that you will see on the charts, and at the end of the day, you're not going to get it 100% right. The markets are moving in the way that they do. They're collecting orders, structures being created, whether it be swing structure, substructure, minor structure. Again, we can create substructure, start creating minor structure, and then create more substructure. And we'll be able to touch on this a lot more once we jump into the liquidity segment. And we'll discuss in the liquidity section how we can filter out, or at least have a better edge on when substructure is being created, it switches to minor structure, but then switches back to substructure and then minor structure before we actually break the swing high. Like I said, a couple different things that we would use with when substructure is being created is looking for demand zones. What might happen is we have demand zone at a lower point. We're building liquidity, and price needs to switch back to substructure to actually come down. But in order to do that, we needed to create liquidity. Again, I'm speaking a little bit out of turn in terms of liquidity. We're going to dive into liquidity in so much detail in the next section, so stay tuned for that. But until then, this is just to get your mind thinking as you're navigating the charts, as you're looking at these three different types of structure. So again, swing structure is going to be your key structure in identifying your overall trending market structure that you'll be following. The substructure is the counter trend structure within that swing range between, in this example, the higher high and the higher low. So the substructure is going to form our higher low in a bull trend or a lower high in a bear trend. And then finally, the minor structure is the pro swing trend structure, which is looking to run the weak swing structures, whether it be the higher high or the lower low, depending if it's a bull trend or a bear trend. And one final thing to note, just to be able to clearly delineate the difference between substructure and minor structure, is substructure ends and minor structure begins when there is a change of character in price. So again, with a bullish example, substructure is creating lower lows and lower highs. A change of character happens, creating a new higher high, so it violates the previous lower high that was being printed, and then we start to see a shift, it creating higher highs and higher lows. So once we see that initial change of character, that's when we're starting to create minor structure, as seen in this graphic right here. So what I recommend now is taking a look at your charts, especially the ones that you would have mapped out in the market structure example of the course. Start identifying your swing structures, start identifying substructure, minor structure, and really understanding the difference between the two, and begin to get more comfortable with the idea of what substructure represents on a chart when it switches to minor, and how we can look to anticipate, say, a previous swing high being taken out to form a new higher high by using the concept of where the substructure is, and then once it switches to minor structure. And then one other thing that you can also do is start looking at your swing structure legs and start mapping out your demand zones and seeing how demand zones in a bull trend, for instance, line up with your substructure in terms of where price reacts off of, and being able to start identifying when a demand zone is likely to get facilitated. Because what you might find is there might be a few different demand zones within the impulsive range, and it's all about understanding the substructure initially as price is continuing to correct to the downside in a bull trend. And again, you can look to enter on any of these demand zones if you wish, but looking for extra confluence, price tapping into a demand zone and seeing that change of character is going to give you the best insight in terms of framing up and building a trade. But again, that's what I recommend doing, is just mapping out your swing structure, mapping out the substructure, mapping out the minor structure, and just getting comfortable with understanding what's happening between these swing points, this low and this high, when price is seemingly moving in between with not breaking structure. Because if not, what we're likely to be doing is just waiting for price to do something, and we're going to be guessing at which demand zones to pick or guessing where price is on a chart to make an informed trading decision. This way, if we're more in line with what's happening on these three different types of structure, we can make better decisions and then build better quality trade decisions and just understand order flow at a higher level, because it's so important to understand these concepts, apply them to the charts, because at the end of the day, understanding your swing structure is going to give you your trend. Understanding your substructure is going to allow you to know where likely turning points are bound to happen, and then minor structure is going to allow you to see that continuation of the trend that would, in theory, allow price to, in this case, run the previous swing high to form a new higher high. Now that we understand market structure, identifying trends, and the three different types of structure that make up a trend, and how we can understand what the market is doing in the order flow that it is creating via structure, we can take it a step further in our understanding and explain. We can take it a step further in understanding protected and targeted structure. So in essence, when we have an uptrend, what we're expecting to see are a series of higher highs and higher lows, with the expectation that every time a higher high is put in, we would start to see some sort of corrective price action that would create substructure to form a higher low. Once that higher low forms, we find some sort of change of character, create minor structure until the swing structure is broken. Now, if we think of structure in its most basic element, what we can say is that once we've created swing structure, we're operating between this range of price. We have our swing low and we have our swing high. Now, when we look at that and we understand that we are in an uptrend, we are expecting some sort of higher low and a continuation of that trend. We would see price creating substructure in the way of a counter trend pullback. We would form some sort of higher low, see a change of character, create minor structure, and then eventually break the previous swing high, creating a new higher high. So in essence, the idea of this structural range that we're seeing between this swing structure, there are two different ideas or outcomes that could happen. One, the continuation of the trend where we break swing structure and create a new higher high. Or two, we break swing structure to the downside, invalidating the bullish trend and switching to bearish. So with that idea in mind, when this high is created, the job of this high is to invalidate the structural level, breaking to the downside, which would then mean that this would be a strong or protected high. But if we are to remain bullish, price will correct. It will fail to break this low or fail to invalidate the bull trend. And once that happens and we start to see that shift, that creation of minor structure, and what that implies is that this low becomes protected and this high becomes targeted. And because we're in a bull trend, what we can see is price then continues to move to the upside. It breaks the swing structure, it breaks this targeted high, and continues to make a new higher high. And if we just delete some of these drawings, and what we'll see is once price creates a new range in price between this swing low and this swing high, and our expectation, if this bull trend is to remain in play, is that we would see this previous swing high broken and forming a new higher high. So the same logic would apply though, that if this low was invalidated and we've seen a break and close below, that would mean we are switching from bullish to bearish. So if we look at this swing high and it successfully did its job in breaking and invalidating this low, we would consider that as protected, as there were enough orders and momentum to push it and break structure. But what we can see is price, again, creates substructure, forms some sort of higher low, starts to create minor structure. And once this process happens, we can start to say that this high has failed to do its job in breaking the previous swing low and switching trend, and that this high is more, and that this low, this higher low, is more than likely going to be protected to target this previous high. And at the end of the day, what this concept of protected and targeted structure is ultimately conveying on the charts is it's just applying the expectational order flow principles of what we can expect in an uptrend or what we can expect in a downtrend. And what do we expect in an uptrend? We expect that higher highs are going to form. We're going to get some sort of pullback. A higher low is going to form. We're then going to move to the upside again, creating a higher high. And the expectation is that will continue and keep continuing until we start to see a change of character, a break to the downside. So when we're using that concept of protected highs and protected lows, targeted highs and targeted lows, so we would know that in a bull trend, the highs will all be targeted and the lows will all be protected, because in essence, price is just continuing to move to the upside. All of these lows are doing their job in breaking swing structure. It's best to focus on protected and targeted highs and lows using swing structure. Yes, you can apply this to substructure and minor structure to create a framework of understanding the interworkings of the order flow that you're seeing, but it can get a little bit confusing when you see multiple things happening, because what you might see is we see a move, we start to see a pullback. So we're starting to understand that this low might be protected and that this high is going to be targeted. But then what we might see is similar to when we were talking about substructure and minor structure, that this component would be substructure. Once we see a change of character, this would be minor structure. But if we don't actually see a true follow through that targets this previous high, then that substructure can then continue before we start to see true minor structure happening. Once that happens, we can start to gain the understanding that this low is potentially protected and that this high is targeted. And again, this all comes back down to understanding trend. We're using the concepts of protected and targeted structure as just an additional tool of understanding what is going on behind the scenes when we are looking at structure. It's not an end-all be-all, it's just an additional tool in understanding what could happen when we're seeing price action navigating throughout structure. It allows us to create a better and more structured framework of understanding where to target our trades. And we'll talk more about this when we get into entries. But when we have, say, an uptrend, we're looking to buy at a higher low. Once the higher low is established, we're under the expectation that we are to continue bullish. And as a result, this high, for instance, failed to take out this low. This low is starting to create minor structure. We've seen that change of character. So based on that understanding, we would expect that this high would be targeted. So if we are looking to trade, especially higher time frame swing structure, like the 4-hour or the daily, we could look to target our trades from a buy position down at this higher low at the previous targeted high and end up closing a portion of our trade to lock in some profits and let the rest run, understanding that if we are truly in a bull trend, that price will then continue to move to the upside to a certain level before we start to see a new pullback in the process, taking over again and again. So that's really the main concept and idea behind protected and targeted highs and lows. So the easiest and probably most simplified way that I can explain protected and targeted structure is that a high and a low, they both have the same job. Their job is to take out structure or counter structure. So highs should take out lows and lows should take out highs. And if a high or a low fails to complete what it is supposed to be doing, it becomes targeted. If it is successful in doing what it's supposed to be doing, it becomes protected. This also roots into looking at supply and demand, because more often than not, these protected areas coincide with supply and demand zones, and that's ultimately what's creating them. Because like I said in the supply and demand section, what we are doing by trading using supply and demand is we're identifying the footprints of large orders being entered into the markets. And when these large orders are entered in the markets, does it seem reasonable that price will go lower of where large orders have been placed? No, it doesn't. We would be riding with those orders. So the understanding of the protected lows in this case would be this low is protected because a large grouping of orders was created at this demand zone. And as a result, the next logical spot to target would be the previous structural swing high. And what we'll touch on more in the liquidity section is also that there are multiple groupings of orders that would exist above the swing high. So from that perspective, we have a protected low, we have a targeted high. Why is it targeting it? Because of liquidity. But again, we'll dig into that into the next section, just to get your mind thinking at the end of the day of what is actually being targeted when this sort of phenomenon happens. But again, these protected points, whether it be a protected high or a protected low, are going to coincide with some sort of supply and demand zone or liquidity grab that's going to see an injection of orders into the market that's going to cause a run or a target of the other side of the structure. So again, if it's a protected low, we're going to target the previous swing high. And if it's a protected high, we are going to target the previous swing low. So what I recommend now doing is jumping to your charts, more specifically to the exercise that you would have done in the previous video, specifically mapping out swing structure, substructure, and minor structure, and really digging into that bit of information, looking at highs and lows, applying this framework to those bits of market structure, seeing when we created a low, was the low successful in taking out the high? If not, was the low targeted? And on the flip side, was a high successful in taking out a low, or was it targeted? And what this is going to do is going to just reaffirm your understanding of market structure. It's going to reaffirm your understanding of trend, and it's going to take you to a whole new level once you're able to fully integrate all of the supply and demand concepts into the market structure concepts, and then apply the protected and targeted structural components to that. It's going to make you a more robust trader in understanding the order flow that's happening on the charts. And then once we dive into liquidity concepts, it's going to just take that to a whole new another level, because what this concept is really bringing into play now is liquidity, why price is moving to the areas that it is moving into. But again, we'll discuss that in the next section. And it's important right now to fully understand this concept and be able to identify it on your charts. One other thing to note about the concept of protected and targeted highs and lows or structure is how we can integrate that to supply and demand. So what I'll do really quickly is just clear up this. We're going to draw in another bull trend, seeing higher highs, higher lows, higher highs, higher lows. And if we're looking at this bull trend from the basis of supply and demand, we know that as price is creating higher highs and higher lows, the higher lows are more than likely going to tap into some form of demand zone, and price is going to continue tapping into demand zones and continuing to move off. So what we're also able to gain from that is, as price is creating the swing highs, it's also creating supply zones that is pushing price down into forming the higher lows that we see on the chart. So when we add in the concept of protected and targeted swing highs and lows, what we're expecting in an uptrend is that demand zones are going to get respected and that supply zones are going to fail and just be totally disregarded. So when we use that understanding, what we see quite clearly is that this supply zone failed to break any bit of structure or take out the previous low or previous demand zone. And as a result, the supply zone is targeted. We keep moving on. This supply zone or high failed to take out this demand zone or low. Therefore, this high or supply zone would be targeted. This supply zone and this high failed to take out this low and this demand zone. Therefore, this supply zone and this high is targeted. And that's another way you can bridge the gap and understand the relationship between supply and demand, market structure, and how we can apply these protected and targeted concepts to that. Because at the end of the day, the understanding of market structure and supply and demand go hand in hand. And as we apply all of the concepts that we've learned thus far, we need to understand how they bridge together, how we can use all of the concepts together. Just to recap and summarize everything, as we are in an uptrend, our expectation is that demand will be respected and that supply will fail. And when we're looking at an uptrend from the perspective of protected and targeted structure, we'd be expecting that all of the swing highs would fail to take out the swing lows. Therefore, the newly created higher lows would become protected and we would be targeting the previous swing structure. And as we continue, our newly created higher high swing structure fails to break our previously established swing structural low or higher low. And as a result, it makes our new higher low protected. And as a result, our previous swing structural higher high is targeted and broken, forming a new higher high. This higher high fails to take out the previous higher low. Therefore, it creates a protected higher low that is going to target the previous higher high swing structure to create a new higher high. And this will continue until we start to see supply being respected and demand failing. We start to see this once we see highs taking out lows, creating the shift from protected lows to protected highs and targeted highs to targeted lows. And this is the interaction between supply and demand and structure, because as we know, we're creating higher highs and higher lows, demand's being respected. In a downtrend, we're creating lower lows and lower highs, and supply is being respected. So the easiest way to remember all of that is higher highs, higher lows, uptrend, respecting demand zones, protected lows, targeted highs. And if we're looking at a downtrend, lower lows, lower highs, supply being respected, protected highs, targeted lows. It's as simple as that, but it's incredibly powerful to understand how all these components work together and how we can use them in a convenient package to understand order flow from a supply and demand and market structure perspective to get the best possible idea and indication of what order flow is suggesting so we can put ourselves in the best positions to win.